depending on where you are across the country. And thank you for joining today's regulatory roundtable. My name is Greg Johnson, and I head up the Technical Services Committee here at Multnomah Group. Today's presentation is sort of part of a document that we generate every year called the Regulatory Update. It was just released in October and goes over all the significant activity throughout the year. And that's what we're going to be discussing today. Today we're doing more of a roundtable format, so more of a discussion. We'll go over some of the provisions, but then I'm joined by Haley McLaughlin and Brian Montañez, who will share some of their thoughts on maybe what these things mean. For any questions, we won't be taking them verbally, but you can use the Q&A or chat features that are on your screen, and we will take questions throughout. So if anything comes up, please feel free to send a note. So some of the things we'll be talking about today, some of the guidance from the Department of Labor, two significant acts that were passed, the Secure Act and the CARES Act. We'll give an update on litigation that continues to be fairly active, and then talk a little bit about some of the mandatory retirement plans that we're seeing established by a lot of states. So first, and probably the most, the legislation that got the most attention this year certainly was the CARES Act. And the CARES Act was passed as a result of the coronavirus pandemic. It was passed back on March 27th, right when everything was just sort of starting. The CARES Act was the one of three provisions, and this one was the one that impacted retirement planning. So that's the one that impacted retirement plan sponsors the most. So just as a refresher, before we start talking about what this really meant with this legislation, the CARES Act allowed very broad access to retirement plan assets to individuals, and then later guidance indicated not only the individual employee, but anyone in their household that was impacted by coronavirus. And we talk about the employer considerations. We'll get into a little more of a conversation about, what this means. What does this mean to really open up the retirement system to very broad access? But before that, let's talk a little bit about what is the CARES Act. So it allowed access to plan assets through in-service withdrawals up to $100,000 or 100% of your balance without the 10% early withdrawal penalty. Now, any withdrawals were still taxable, but the tax liability could be spread over 3 years. In addition, any money that you took out for a CARES Act in-plan distribution could be repaid within 3 years. So if someone was otherwise eligible, maybe for a hardship distribution or something like that, the CARES Act or the coronavirus-related distribution, the CRD, was probably the more attractive route because it had these additional features of spreading out the income tax liability and the ability to repay if the individual chose to do so. There were also some loan provisions, expanded the loans up to $100,000 or 100% of your account. Prior to this, the current rule is $50,000 and 50% of your account. It also allowed for payments on existing and new loans to be delayed until January 2021. Now, this loan provision actually expired September 22nd, so that is no longer available. The other in-service withdrawal and the plan distribution rules expire at the end of the year. So it'll be interesting to see if there's increased activity in some withdrawals from plans as we get sort of to the end of the year. There was an additional provision that wasn't really an in-plan provision, but it related to required minimum distribution. And it removed penalties for the failure to take required minimum distributions in 2020, which essentially waived any RMDs for the year. And just as a reminder, the penalty for not taking your RMD is significant because it is 50% of the amount that was supposed to be withdrawn. So having that penalty removed for the year was significant. Interesting things about this RMD one, it doesn't require the individual to be impacted by coronavirus. So this applies to everyone who was required to take a minimum distribution. And then also there was some guidance that came out from the IRS after this was passed, indicating that an individual who had already taken their required minimum distribution. So let's say you took your RMD in January, but you really didn't want it. It extended the time that you could roll that over through August 31, 2020. So it did take into account individuals that maybe had already taken their RMD before the coronavirus impact would still be able to put that away. So when you think about those provisions, and maybe I'll start with Brian, what was your experience from the institutional side? What did you see from plan sponsors related to the CARES Act?
Yeah, thanks, Greg. So it was interesting the way that the retirement industry approached this legislation. Many vendors came out with the default. You are going to be defaulted into all these provisions or defaulted out of all these provisions. And you could change it at any point in time. But in my experience, most vendors sent out a note that said, we're going to default you into accepting all of these provisions unless we hear from you otherwise, or unless you come back to us at a later date and change your opinion. But in my experience working with clients, whether or not they offered these very much depended on whether their record keeper defaulted them in or out. And fortunately, or unfortunately, I think I saw most vendors opted people into the plan. And what I told my clients last quarter when we went through this was, you may not hear me say this again, but I think Congress got this one right, but it's a double-edged sword. What I mean by that is they took the plan sponsor out of any liability for approving these distributions, right? So the participant can self-certify. So from the plan sponsor perspective, that made life easier and it made more life efficient for the participants. Congress got it right in the sense that there's no penalty for taking out a hardship distribution, a CRD, a coronavirus-related distribution. And that makes a whole lot of sense to me, which is why are you penalizing people when there's a pandemic? It's not an individual poor decision they made, it's a pandemic. And you can pay those taxes out over 3 years, which makes a whole lot of sense because if you take money out now, 20, 50, 75 grand, come April, you may not be able to repay those taxes. But if it is a short-term issue for you and you do get back on your feet quickly enough to be able to put the money back into a qualified plan and not pay the taxes, I think that's actually really, really cool. But the double-edged sword is easier access, penalty-free money is going to spur people to take distributions. And as Eric Daly was saying earlier this week, you got to wonder, is Congress turning these into more of a tax savings plan, or are they really long-term retirement plans? Because every time there's a concern or an issue out there, Congress comes out and says, okay, we'll allow you to take your retirement plan assets. So double-edged sword, but generally speaking, I think they got it right.
Right.
Yeah.
Thanks, Brian. Haley, what about on the individual side? What did you see? How it sounds like a lot of plan sponsors adopted it, certainly, but then what were the employees doing?
Yeah. So if you want a little bit of an example of what Brian was just saying, we were getting information from our record keeper partners on the adoption rates, and one that defaulted plan sponsors into the CRDs had a 97% adoption rate. One that did not default, that plan sponsors had to reach out, only a 37% adoption rate. So really significant changes, once again proving that defaults work.
Yeah.
On the participant side, I think that there was a fair amount of concern, especially early on, that this would be just a flood of assets out of the plan. We haven't seen what I would describe as a flood, but there's still plenty of time for participants to take these assets. So one of our largest record keeping partners provides monthly information, and as of August 31st, just over 4% of participants that had CRDs available had taken them, and the median amount that was taken was $3.8 thousand. So not a huge amount. The average taken was $11,000. So we're not seeing these huge $100,000 withdrawals, which is great. But when you consider what maybe the median and average account balance is for these plans, well below $100,000 anyway. So certainly we know some people are emptying out their account, which is a clear concern. We saw far fewer participants taking the loans, and I think they were doing the math that Greg described. Certainly if you need money today and your financial security is perhaps in jeopardy because of the pandemic, it's better to take money that you don't have to pay back but have the option to than do a loan that you're going to have to pay back. So very few loans taken. We did see a few folks defer those loans. I think 4.7% of current loans were deferred from this record keeper who had provided us information. So a little bit of an uptake, but not significant. And at this point, those have expired. I think one thing we'll want to continue to watch as this end of year deadline looms for the CRDs, if we get more folks taking it right at the end of the year to try and take advantage of this. So while we haven't seen a huge wave yet, I think that that's still a possibility.
Mean and median, that's what you get, Greg, when you ask an actuary a question.
Well, I think you're certainly right. The distributions were clearly the more popular. You know, now loans is a little bit of a double-edged sword as well, right? Because it gets re-amortized and you end up paying more money total when you end up repaying the loan. That provision, it's on the slide, people who stopped payments have to restart that in January of 2021. The RMD one is sort of interesting because the first two involve access to money, right? How do I get money to get through the pandemic? Stopping required minimum distributions is a way to keep money in the plan. Why would that provision have been included?
Yeah, let me comment on that one. So as they did in 08, 09, you know, RMDs are required. So there's a date, tax date that you have to take that money out. And if you went back and look at those charts of Q1, when most people were preparing their taxes and getting ready, you might have made someone take out their distribution, 20 or 30% down from where they were. So again, I think that Congress got this one right, which is removing the penalty so that those that are privileged enough to not have to live off their RMDs weren't suffering a significant loss just simply based on the time. And if you, again, look at those charts, we're back to all-time highs, and we got there pretty quickly from the lows of March. So good provision there, I think, again.
Couldn't have foreseen the quick return in the markets that happened. I mean, when this was passed, the market was down, 20 to 25% in about a 6 to 7 week period. So you can certainly understand them wanting to move on that. There's also some employer considerations on the CARES Act that I just wanted to talk through. Brian mentioned employers were not required to adopt the provisions, but most did. One interesting point is that an employee who is otherwise eligible for a distribution could treat a distribution as a CRD, even if the plan did not. So they could take advantage of some of those tax benefits. Brian also mentioned employers could rely on an individual's self-qualification for a CRD or loan extension. So it really did take the burden off the employer's need to, to have to monitor and determine whether someone actually needed this. One final note, plan sponsors must amend their plan documents by the end of 2022. Haley mentioned that these expire 12/31. There are some things that people will need to be aware of, though, after the end of the year. All the loans that were extended need to be re-amortized. Obviously, the plan sponsor needs to amend their document. And it's really up to the individual to do their taxes correctly if they do plan on spreading out that tax liability for the 3 years. A final comment before we move on to the Secure Act. Brian touched on it. And as a practitioner, when this came out, I do think access to the retirement system was important. And I think it was needed. This was so broad, though. The access that was provided to people really opened up the entire system. And I mean, even later guidance extended it to family members. That further guidance even said that the amount withdrawn did not need to match the actual need that the participant had. So this truly was opening it up. For me, I'm glad to see that people didn't come running to the bank and take all their money out. I think the impact of someone pulling out $20,000, $30,000 from their retirement plan, it can have a significant impact on when and how they retire. So again, I think this was needed, but at the same time, a little scary to open up the entire system in that manner.
I agree.
All right. So that was the CARES Act, which is sort of a short-term, not solution, a short-term legislation to address the pandemic to some degree. Prior to that, actually in December of 2019, the Secure Act was signed into law. And at the time, it was considered the most substantive update to the retirement system in over a decade. Little did we know that we needed some significant help as a result of the pandemic that was heading our way. But it is true, this did have a few significant provisions. Probably the two biggest things that came out of this are some provisions to encourage small employers to offer and enhance their plans, and then an increased focus on lifetime income. So as far as the small employer plans, there are a couple things. It creates a new plan called a pooled employer plan, which is a new type of multiple employer plan that'll begin being available January 1st. It relaxed some of the rules for eligibility to participate that we had seen in MEPs or multiple employer plans. It removed, a MEP had a requirement that the employees participating have some nexus or some connection to each other. It removed that. So really, if someone opens a PEP, any employer that wants to join, which should be able to join. And then it also removed what's called the one bad apple rule. And the idea of that was if you have a multiple employer plan and there's one employer behaving inappropriately or violating the rules, it could have disqualified the entire plan, impacting everyone involved. So it relaxed both those and created this new PEP that'll be coming out this year or next year. So, I guess my question to Haley and Brian is, who do you anticipate offering these plans, and what sort of impact do you think it'll have?
Yeah, I was actually involved at the multiple employer plan back in the 90s, setting one up. There are three industries that I could see creating a PEP. Banks, clearly, they can do a lot of that work already, and they have that distribution arm in terms of plan sponsors having a banking relationship or calling a bank because they want a financial product. Second would be chambers of commerce. It makes a lot of sense to me for a chamber of commerce to offer as a benefit to its members a retirement plan. A retirement plan that offers to offload a lot of the investment work, a lot of the administration, a lot of the coordination. That makes a lot of sense to me. And I think you're going to see more third-party administrators, so TPAs, by the general nature of their business. They are very good at administration. Many of them offer record-keeping platforms. So I think that's probably going to be the most successful market, is a third-party administrator bringing these to bear. And why will they be successful? I think it depends on your size, your asset size. So if you have, say, less than $1 million or less than $2 million, and not you as an individual, you as the plan, you're looking at 2% all-in fees for administration, investment, and record keeping, and that's a brutal number. If we can get those numbers cut in half, that 1% that you can save, that can add a third to your retirement balance over a lifetime of savings. And these small plans, $500,000, $1 million, it's sad to me that, just because a person works for a small shop, they're going to have a lower retirement balance at the end because of those fees. So yeah, I think banks can get into it. I think TPAs will probably be the most successful. And chambers of commerce, I think, really should look at it, because most of their members are going to be, barbers and mechanics and small business owners. So those are my thoughts. Haley?
Yeah, I agree. The other player I can see would be payroll providers, maybe getting into that market. I agree. Chambers of Commerce makes a lot of sense. And it's interesting because we are trying to solve for this coverage gap for people that work for small employers in a variety of ways. This PEP is one way. I know we're going to talk about state initiatives the other way. And so it seems like we're coming at this from a variety of different angles. And it'll be interesting to see in the future, as these both expand, if they coexist together or if one beats out the other, and we see either these state or federal initiatives or PEPs be the future of retirement plans. But I think that it's just another interesting way to try and solve for that coverage gap, which we know is such a problem.
And I think it's going to be interesting to see, there's cost efficiency that Brian's talking about for sure. And I think that's really what people think of first when they think of these PEPs. The other advantage, though, if you think of a small employer, they might have enough money to open a plan, but they might not know if they have the staff to properly run a plan. And so the opportunity to maybe shift some of their fiduciary liability onto the PEP provider is a benefit that might honestly outweigh some of the cost savings. And I think when you go upstream to bigger plans, but I don't think the cost savings are going to be quite the same. And in fact, in some cases, it might even cost more to join a PEP. But an employer who says, I'm not really sure my staff can properly run the plan, this would be a very attractive option. So the other benefit to a small employer are a couple tax incentives for employers with 100 employees or less. It increased the tax credit for starting a new plan from $500 to $5,000, and also introduced a new $500 tax credit for adding auto enroll to an existing plan. So I think, the point here is not to provide new tax benefits to employers already offering plans. The goal here is to encourage employers to decide, okay, I'm ready to offer a retirement plan to my employees. The second most substantive piece was the increase in the importance of lifetime income. There's two pieces to this. The first, it requires all employers to provide illustrations of monthly payments that one would receive if they annuitize their current balance at age 67. So basically, if I'm 35 years old, they're going to look at the balance that I have and provide an illustration indicating that if you were 67 today, this is the amount of lifetime income you would have. And I don't know, Haley might have a few comments about whether that's the right way to do it or not, but that is the rule. That's the guidance that we got. The second piece of this is it provides employers a safe harbor from liability for the selection of an in-plan lifetime income annuity provider. So it allows employers to begin offering an in-plan annuity. Actually, I'll just open it up to Haley. I don't know if you wanted to add on the guidance that we have on how to calculate that.
Sure. So, I think that illustrating what monthly payments would look like is a really great goal. I think that that's the way participants think about their budget and think about how much money they need in retirement. But the way that we're doing this illustrations is tough, and I think it might spook a lot of people, especially folks who are young and early in their careers or have low account balances. Because if you take a 35-year-old who has, $50,000 saved and pretend that they're 67 and retiring today, they're not getting much in monthly income, certainly not enough to survive. So I think that may spook participants. Additionally, a lot of record keepers are already providing really good, interesting illustrations of monthly payments, but they're projecting forward. They are assuming that you're going to save at this certain rate and you're going to gain this much in investment return. And so, while that's maybe a more likely illustration and makes maybe more intuitive sense, it's also projecting, which is hard to do, and we don't want to make people think that this is a guarantee, right? We don't want to tell them that you will definitely have $1 million in retirement if you continue what you're doing, and have them say, okay, great, I'm going to just stop. So I think it's a tough thing to do, and I'll be interested to see what the response is from participants when they start seeing these illustrations.
Yeah, I agree with you, Haley. Just putting that number, converting that number from an asset balance, which makes you feel rich, to an income number. I think that's going to do a whole lot of good in getting people to understand what their retirement preparedness is. So I've been looking. This is probably year 5 that this has been talked about. So I'm very glad to see it out there. And regarding an annuity, an annuity is a dirty word. But I think for most people in this country, I think most people in general, an annuity will save them from themselves and provide that underlying income, just like Social Security. I know that the majority of people that are in defined contribution plans really, truly don't know how to invest their assets, let alone how to spend down their assets at a reasonable rate. So to have a floor to complement Social Security, I think is actually going to be a really good thing, even if it does add just a little bit more expense. I think it's probably a pretty good thing for the average person. Or should I say mean person?
Median person.
The median person and the mode. Sorry.
The majority of my career has been spent on the nonprofit side and 403B plans. And, it's pretty typical to see an in-plan annuitization option. And, the research and the evidence is pretty clear that the likelihood of turning a portion of your retirement into a lifetime income stream is significantly higher if you have an option within the retirement plan. So I think this is a positive development. I think it, well, just a moment to go back on the safe harbor, just to explain what it is. In 401k plans and for-profit organizations, they're very reluctant to offer an in-plan annuity for concern that they would ultimately be liable for that insurance company's success, 20, 30 years from now. So if I have an in-plan annuity and someone annuitizes and, at some point the insurance company goes belly up, the employers were concerned, well, wait, am I going to be liable for that? So it's very understandable why they would have been reluctant to move into this space. I don't know how quickly it's going to be adopted in the for-profit world. I think it's going to take a little time for plan sponsors to warm up to the idea of having a lifetime income option within their plan. But I do think 5 years from now, this provision will actually have a significant impact on how we retire. Because I think Brian was sort of alluding to this. I think we already know that we're not great at saving for retirement. We're entering this era where defined benefit plans are largely gone, and we're just starting to see people entering retirement where their only available assets are their defined contribution plan and Social Security. And while we know we're not great at saving, I think we're going to learn shortly that we're even worse at spending. When we start taking money out of these plans, that it's going to, people don't know the best way to do it, and they don't have a plan on how to successfully fund their entire retirement. And setting up an income stream that you can't outlive is a critical piece to that.
I agree. I think we're likely to also see a lot of these providers, these insurance companies, these annuity providers come up with new solutions for this plan. So I'm expecting, maybe not in the next 6 months, but in the next 18 months, 24 months, to have those rolled out. And these products are so complicated and so complex that it's going to, I think, likely take a lot of selling from these providers to get these into plans, at least at the beginning.
Yeah, I think we talked about that once, right? That they're going to be sold the first few years, and then they'll start to be bought a few years after that. I think there's definitely an education angle that's important here.
Absolutely.
So those were the two biggest things that came out of the Secure Act. Also part of the Secure Act, there were a lot of sort of one-off provisions, a lot of things that just sort of, they didn't all tie together really well, but but they were developments in the industry. Some of these are even could just be counted as housekeeping items, some things that sort of needed to be cleaned up. I'm not going to read through all 9 of these. We'll distribute the slides afterwards, but maybe touch on a few of them. And maybe we'll start with Haley. Of these 9, which one do you think is perhaps the most significant, or that'll really have an impact on the retirement plan industry?
Yeah, well, the only one that I've heard participants already ask about is this penalty-free withdrawals for the birth or adoption of a child, which basically allows you to take up to $5,000 within the year that there's a birth or a legal adoption of a child. And it removes that 10% early withdrawal penalty, and you can pay back some of that withdrawal. I think that generally that makes a lot of sense. There's a lot of expenditures, right, when you have a child. And I haven't seen a lot of pushback from plan sponsors on adopting this provision. I think the sticking point will likely be that option to pay back the withdrawal. And we're still waiting on further guidance on what exactly that payback will look like. But I think that from an administrative perspective, that's probably the biggest stumbling block is, are we adding a whole new contribution type, a whole new money type within these plans? So I'm excited to hear what the further guidance is on that piece.
Yeah, and how do you track it too, right?
Exactly.
So a 30-year-old married couple each takes $5,000 out, and then when they're 55, they decide, hey, I've got some extra income here. I'll go ahead and put that in. How do you know that it happened? I mean, assuming they're even at the same employer. So
Right. And it could be a totally different employer, a completely different plan. At this point, it seems like a bit of a mess. So I'm really hoping that guidance clears up some of these open questions.
Brian, is there anyone that sort of jumps out at you?
Clearly the second one. And Haley spoke from the participant perspective. I'll speak from the employer perspective. The second one that requires employers to allow part-time workers to make voluntary contributions. So first off, we have to separate employers. So if you're a nonprofit and you offer a 403B, which has a ton of part-time temporary workers, this rule doesn't apply to 403B plans, but it does apply to 401k plans. And honestly, I don't like it. I love the idea of letting more people in the plan, but the administrative burden that goes along with this is pretty tough. First off, the 3 years mentioned here, 2021 is the first of the 3 years. So you're going to have to track those hours for all those years. And then after 3 years, you may or may not have to let a participant in the plan. And the reality is if you're working under 500 hours, you're probably not going to participate in the retirement plan. But the biggest problem comes if you go back to look at eligibility, you're going to, and potentially vesting, you have to track those 500 hours for all these prior years too. So you're going to have to keep a very long spreadsheet or keep very good records of how many hours all your employees have worked, including going back in time to the past couple of years that have already passed. So this is a difficult one. I don't like this one, but it is a law. It is a rule. So we're going to have to, track it. And maybe the employer will redesign their plan to change their eligibility for salary deferral to be more lenient so that they don't have to deal with these administrative issues. They can just make everybody eligible for voluntary contributions. And I distinguish voluntary from employer, right? So voluntary is salary deferral. I put my own money in, but the employer contribution, this rule does not apply to the employer contribution. So plan design may be an effective way of addressing this potential administrative burden.
Yeah, thanks, Brian. Yeah, for me, the head scratcher here was that third one that increases the maximum auto enroll, auto save limit from 10% to 15%. Auto enroll is where you mandatorily, automatically put the person into the plan. Auto save is sort of the auto escalate where you increase the amount over a period of time. I think auto enroll and auto save are great. I think it's fantastic to sort of put people in the plan, sort of force them to opt out. Those provisions have had a huge impact on people's savings rates. So very good provisions. I've never seen an employer push their auto increase up to 10% even. And so now that's been increased to 15%. So, I mean, that's fine that they increased it. I just don't see that one having much of an impact. That was probably the head scratcher. The other one was the elimination of the stretch IRA, shortening the time that a non-spouse beneficiary can take out an inherited retirement account. This actually will generate additional revenue for the government on these plans. Just as an example of how that would work, if a 30-year-old in the current environment inherited an IRA or a retirement account, they were allowed to extend those distributions throughout their life expectancy. So they could extend them until their life expectancy, which is probably 80 plus years old. So you can imagine they're taking very small amounts out if they didn't really need the money right away. This rule changes that so that those accounts do have to be depleted within 10 years. So if you inherit an IRA or someone's retirement account, you now have to begin taking more aggressive withdrawals than you maybe would have had to. Any other thoughts on the Secure Act before we move on to some of the Department of Labor stuff?
Not for me, sir.
No, it feels a lifetime away at this point.
Yeah, it's fine. I mean, everyone's making such a big deal out of it when it passed. And the interesting thing, though, is those Secure Act provisions will end up having the longer term impact on the retirement industry. And CARES Act, even though it got everyone's attention, was mostly sort of short term.
Yep.
All right, we did get some guidance from the Department of Labor on a few items. And the first one was the expanded safe harbor for e-delivery of plan information. Now, there is a safe harbor that already exists, and it does allow an employer to do electronic delivery to anyone with access to the employer's computer system. So essentially anyone who has access to their email account, and then anyone else who perhaps opts into delivery. So if someone gave, maybe a separated employee said, here's my email address, just send everything to me electronically from now on, that was the current safe harbor. That's not going away. That still exists. So if someone's operating under that, they can continue to do so. The new safe harbor allows the employer to notify participants that we are now switching you to sending everything electronically, or we're going to post everything to a website. So an employer who wants to do this, they do have to send an initial paper notification. So you do have to send them a physical letter. That physical letter must include the email or phone number that you will be using for that participant. So there's a little bit of a customization piece for employers that have to take into consideration. So it's not just a form document that you're sending out. And it has, that letter also has to indicate that you can opt out and say, I want to continue receiving paper. After you send that initial notification, if an employer is going to elect to post things on their website instead of including in the emails, you do still have to send everyone an email with very clear instructions on how they can access the document. And that also must include some information indicating how they can get a paper copy if they wish to have that as well. And this covers things like summary plan descriptions, summary material modifications, statements, summary annual reports, fee disclosures, safe harbor QDIA notices, and blackout notices. So Haley, I actually have a question for you on this one. So Haley's the head of our vendor services committee. So she works with a lot of the plan providers. And when you think of that list of documents that can be sent, you know, some of these are the plan sponsor sends, and some of them the record keeper sends. So I think both have an interest in you know, making this rule be effective. So what are you seeing from the vendor side?
Yeah, so I think it's important to note that this is an additional safe harbor. You don't have to move to the safe harbor. You could keep doing what you were doing in the past with no issue, but I think we're going to get a pretty hefty push from the record keepers to move to this new safe harbor because, as you mentioned, they are doing a lot of the fulfillment, or at least some of the fulfillment of these various notices, and they like to do it in the most efficient and cost-effective way possible. So I think not to keep harping on this, but the CARES Act sort of distracted from the creation of these new procedures for record keepers. They had to deal with CARES Act and so weren't building out what they needed to for these e-delivery. But we are starting to see more and more record keepers roll out new procedures. If you want to use this safe harbor, I think that through the end of the year, we'll continue to see that. And I do expect a fairly big push to move plan sponsors and plans to this new safe harbor.
And I would add one thing, which is safe harbor. Vendors are very well capable of maintaining a database of who chose to opt out, but plan sponsors, maybe not so much. And keep in mind, a participant may opt out of electronic and say, no, I do want paper. And it is the plan sponsor's administrative responsibility to document that and then send paper in the future. So record keepers, perfectly capable of doing that. HR is going to have to consider that when they look at how to handle this going forward.
Definitely.
Yeah, that's a good point. There's also a new fiduciary rule that came back that actually had sort of a lot of similarity to the prior rule. Haley, do you want to walk us through that real quick?
Sure. So we've been talking about fiduciary rules for several years at this point. If you remember, we had one back in 2016 that eventually sort of died. And so we have this new rule, and it does a couple of things. One, it says that we're going back to this 5-part test to determine if someone is a fiduciary. That's just codifying that we're remaining at the status quo. When the last fiduciary rule died, we moved to the 5-part test. So this is just reconfirming that, making that official. The other thing is that it is tying itself very closely to the SEC's Reg BI, so the best interest, and they've said that if you are complying with Reg BI, then you are complying with this new fiduciary rule. So they're really trying to marry those up. The Reg BI went into effect June 30th, and so we are still really in the early days of that, and it's being self-enforced at this point, right? We're not seeing audits of it, so we're not, I think, sure that Reg BI is working to protect consumers yet because it's so new. And so to have an additional rule that says that it's doing the same thing while we're still not sure if it's working is a little bit weird for me, frankly. But generally, fairly standard stuff. A lot, as Greg mentioned, a lot of the stuff we saw in the initial fiduciary rule, I think this has fewer protections. Frankly, it's a little bit watered down. One big thing I think it does do is around IRA rollovers. So prior to this new fiduciary rule, generally we said that distribution information was not fiduciary, right? If you talk to someone about whether they should roll out into an IRA, that wasn't fiduciary advice. Now this new fiduciary rule says that it may be if it's establishing relationships, establishing an ongoing relationship or part of an ongoing relationship. So that's a change. And it'll be interesting to see how the record keepers, especially those that have really big IRA rollover businesses, handle that. So I think still some to come. We haven't gotten the final rule yet, so there could be changes. So we're just sort of a wait and see at this point.
All right, thanks, Haley. Now let's move on to some proposed rules, or a proposed rule from the Department of Labor. There's a proposed rule on ESG investments. So that's environmental, social, and governance investments. The DOL has expressed some concern that offering these types of investments might not be in the best interest of plan participants' retirement savings. And the rule for any investment committee is that everything must be done for the best interest of the participants. And the specific language that they have is that retirement plans are not vehicles for further social goals that are not in the financial interest of the plan. So ESG investments, they need to be monitored and held to the same standard as any other investment in the plan. So you can't have them there and say, well, we don't really monitor that one as closely because we just know our people really like to invest in this manner. The rule did receive a fair amount of negative comments. So, we're going to keep an eye on it. But maybe, Brian, what do you think this means for plan sponsors who are considering, who have an ESG option on their platform or maybe considering adding one?
That's a tough question, Greg. So my first comment would be, make sure your investment policy statement documents that you're not giving preference to the ESG factor. And then you are evaluating the ESG funds or investments the same way you do a conventional investment. But for now, status quo, because if we look back over the DOL's interpretation of how and whether or not to offer ESG, there's been a very strong correlation with the presidential administration. Because remember, the president gets to appoint the head of the DOL. So you can go back and look at each different administration, and they both lean a little differently each time. And here we are just a couple of weeks away from the presidential election. So we could end up getting new rules or rules redacted, or I just don't know, Greg. At this point, document why, document that, document how, and just make sure you have a record and you are prudently monitoring these funds and making sure that they are appropriate investments regardless of the ESG strategy, and make sure you have that documented somewhere. And then stay tuned, and we'll see what if the current administration wins, then we're going to have to look at this a little harder. If there's a new administration, as is consistent with prior administrations, I bet we will see some new thoughts on ESG investments. So hang tight and keep your documentation handy.
All right, thank you. So now we're going to talk a little bit about litigation. As you can see in the slide here, there's been a significant increase in retirement plan lawsuits. And what we have listed here is the allegations that have been very similar to the previous lawsuits, where in fact, some of these filings are so exact that the number of pages in the complaint is exactly the same. I mean, we're seeing these things verbatim, with the only thing being changed is the employer's name and the plaintiff. So, the typical claims against the fiduciary are failure to negotiate lower record-keeping fees or solicit competitive bids, failure to properly monitor investments or offer alternative investments that would have performed better, offering too many investment options. Actually, we've seen that one pretty routinely thrown out. Failing to include the lowest share class of certain investments, offering mutual funds instead of collective investment trusts or pooled investment vehicles that were perhaps less costly, offering multiple record keepers, which the allegation is that increased the overall cost to the participants, and charging record-keeping fees based on assets rather than the number of performance. Some of these have a little stronger standing than others. Others I just don't see flying. I've seen a few complaints that suggest that the plan sponsor should use only indexed funds instead of actively managed funds. I just don't ever see that getting any traction. I don't even think the investment industry has really come to any sort of conclusion that active is better than index. And I think there's arguments for both in different market situations. So I keep seeing that one pop up, and that one's probably the head scratcher to me. As we move on in the litigation update, there continue to be lawsuits filed against some of the largest, private institutions. So we haven't really seen anything in the public university arena, but there have been 21 suits filed. The most recent was filed against the University of Miami in April. I don't have the number, I think about 8 of them have settled. One of the things that we're seeing, they come with monetary damages, which are expected. And you can see there's damages ranging from $225,000 to $18.5 million. But the other thing that we're seeing is pretty consistent non-monetary requirements being placed on these plans. And to be honest, I'm familiar with a lot of these plans. A lot of them had already moved and adopted some of these things that were already in place. But some of those include a requirement that the plan sponsor hire a third-party consultant. They're required to complete a new RFP, usually within a fairly short amount of time. Several of them require the plan sponsor to provide the plaintiff's counsel information on investments, fees for a period of 3 years. And the other one that we're seeing pop up is this prohibition against record keepers' use of employee data to market non-plan products. So, what are your thoughts on that? Maybe I'll start with Brian this time. What are your thoughts on that last one related to the data?
That is a very difficult one. First off, let's be clear. It's being litigated now, and participant data, this concept of participant data being a plan asset is not found in ERISA. So it's being litigated, and we'll see what happens if we get guidance coming out of the courts, but it's currently and actively being litigated. Second, practically speaking, this is a very difficult one because the entire record keeping industry is set up to gather participants, gather new clients from the record keeping world, and is that a bad thing? That's something that you and your committees, your plan sponsor, have to evaluate, is whether or not you want your record keeper to solicit or, more politely, to offer financial advisory services to your participants. And in many cases, that is seen as an ancillary benefit, which is, we can work with you in the 401k or 403b, your IRA, your private wealth, and that is considered to be a benefit by many record keepers. So I'm nervous about this one, honestly. I'm more nervous about this one than I've been about anything I've seen in the last 20 years. This could completely upend the record keeping industry. If they can't offer participants financial services, will a plan sponsor want to work with them? And if they can't offer those services, or if they do and you have to monitor them, that's a monumental task. But if they can't rely on that sort of service and relationship with participants, you're going to see prices change dramatically and immediately. So this is something we absolutely have to keep an eye on in the courts and see what comes out of it. That's my opinion. People may have different opinions, but from working in this field for over 20 years, that's kind of where I've settled on this thought for now.
Haley, any thoughts as you think about the vendor services committee and the record keepers out there?
That's certainly something we're going to continue to monitor. I think one of the biggest lessons we've had from a lot of these settlements is around the surge. It seems pretty clear that the courts think that a full RFP is a better tool for evaluating services and fees than anything else. So even if you're sort of benchmarking every year, it's become pretty clear that a benchmark isn't a search. And so I think we are likely to continue to see settlements that require this formal request for proposal process. And if I were a plan sponsor, I would maybe take a look at the last time I did a search and make sure that I have all of that documentation ready. I mean, I think again and again, it's document your process.
Yeah, for sure. Yeah, and I think the data issue is, it's interesting because there's more and more conversation about financial wellness and the overall financial picture of the individual. And this is not consistent with that. We're seeing the industry talk more about what's your financial picture look like, not just your retirement plan. And I would suggest that this sort of goes against that.
Absolutely.
So a couple more things on the litigation, and then we'll sort of wrap things up. There is a new lawsuit that focuses more on the investment advisor than the plan sponsor. And we've seen investment advisors be included as defendants with some of the 401k litigation, but this one is strictly against the advisor. The investment advisor moved from a 321 to a 338 advisor, and the allegation is that as they moved money within the plan, they moved it to use their proprietary investment products, which actually carried a little higher cost, increasing the benefit to the advisors. So again, we'll have to see how these move forward. Real quick, Brian, do you want to just distinguish between a 321 and 338 advisor for those who might not understand the difference?
Yeah, sure. So first, being a fiduciary is a position of exceptional trust, right? You're supposed to be doing your work with the best interest of a third party in mind. A 321 advisor is where your investment advisor gives you a recommendation. We think you should remove this fund. Here's why. We think you should add this fund. Here's why. But you, the plan sponsor, the fiduciary, the committee, make the ultimate decision to say yes or no. A 338 is really an investment manager where I'll come in and say, my investment committee has decided to make this change. I'm informing you of this change, but as a 338 investment advisor, I have the liability and obligation to take action when I see fit. So 338 makes the decisions for you. 321 provides you with that recommendation. And if you go out and look at these court cases, it's unconscionable that a 338 would put their own proprietary investment products in, even with a higher fee. That really kind of got my goat.
All right, and then the Supreme Court actually weighed in on a couple, and I'll just touch on these quickly. There was a 5-4 decision that dismissed a case, fiduciary duty case on a defined benefit plan, so not a defined contribution plan. The allegation was that the investment committee caused the plan to lose some $750 million in assets due to their investments. In this case, though, the employer continued to meet its obligations under the defined benefit plan, so there wasn't really any harm to the plaintiffs. And then in a unanimous decision, the court ruled in favor of a plan participant, talking about what the term actual knowledge means. And they ruled against the employer. The employer had provided access to certain disclosures related to the types of investments available in the plan. There was even some indication that the participant had opened one of these documents, but it was deemed that just showing that you posted it did not result in the participant having actual knowledge regarding the investments in the plan. The other thing that the Supreme Court action that we see is the Schlichter firm has appealed the Northwestern case to the Supreme Court. And essentially, I mentioned that a lot of these allegations look exactly the same. They have 2 circuit courts that have allowed cases to proceed, and then the 7th Circuit dismissed the Northwestern case. So they're basically taking that to the Supreme Court to say, basically which one's right, which one can we proceed with this, or are the other 2 courts right? So that's one we'll definitely be keeping an eye on. So I pretty much took us to the top of the hour. The last thing we're going to end on is state mandated retirement programs. And I think for this one, I'll turn it over to Brian to make a few comments. You know, the one thing I'd say is, Haley mentioned it earlier, we have a retirement crisis, and what's the solution? And one solution that's happening right now is states are saying, look, federal government, if you're not going to mandate a solution, we're going to do it ourselves. So we've got 12 states and 1 city that offer state-run plans. I don't know what the answer is, but I'll turn it over to Brian to sort of share his insights.
Yeah, this is a difficult one because if you think about it, you know, we as Americans and your small business owners really don't like being told what to do. And that's just true. The idea that you have to do something, that's a tough one. But you know, if you have less than 100 employees, only 53% of the country offers a retirement plan, an employer-sponsored retirement plan. And if you think about it, small businesses are the lifeblood of this country. So nationally, we have less than half of the people in this country that are covered by a retirement plan. And behavioral finance and the statistics will show you that people don't save for retirement unless the money is taken out of their paycheck before they get it. And when you do take the money out of their paycheck, then they will save for retirement. So yeah, it's a tough one. I would hate to be a small business owner who's told that they have to have a retirement plan, and you know, if they're small, it's another administrative burden. But the reality is we as Americans don't voluntarily save our own money. It has to be taken from our paycheck before we get our hands on it. And that is the most effective way to help solve this retirement crisis, is to not give participants the option, or rather to give them the option of having it automatically deposited in any kind of qualified retirement plan, be it a employer-sponsored plan or an IRA. So this is a tough one. And I'm going to let the conversation drop with a thud right there.
All right. Well, again, we went right up to the hour. I didn't see a lot of questions, but if you do have additional questions or concerns or thoughts on any of this, please feel free to reach out to your consultant. We will also be sending everyone a copy of the deck, and you can submit questions that way. I do appreciate everyone's time. I know that everyone's very busy. So with that, I think we will end right at time. Thank you, everyone.
Thanks, Greg.
Have a good day.
Mm-hmm.